My greetings and salutations to all. In the ongoing series of Finance for Everyone, today we have a very pertinent topic relating to investor behavior, market behavior, customer behavior, and the stock market bubble. So this will be the flow of the lecture. We'll be talking about the definitional aspect of investor behavior, followed by market behavior, then about importance of understanding investor and market behavior, followed by types of investors and the behavioral finance theory and how it is related to investor behavior, followed by the concept of the market cycles, market bubble, investor psychology, the concept of management and market efficiency. So let me first start with the investor behavior definition. The decisions and the behavior that people, groups or organizations make while investing their money in the financial instruments like stocks, bonds and the mutual funds are referred to as investor behavior. For the market players, comprehending investor behavior is definitely very essential since it has a big impact on the market trends, asset prices and overall market stability. The risk tolerance, investing objectives, financial situation, the political and economic climate and the investor psychology are just a few variables that affect the investor behavior. The branch of finance is called as behavioral finance. Let us see what it is. It is about the psychological and the emotional biases which influence the investor choices, investor behavior. Significantly, it is influenced by the investor psychology. The investment decisions are frequently influenced by the human emotions like fear, greed, and overconfidence, which can result in cognitive biases, such confirmation biases, available prejudice, and the recency biases. Another psychologist biases that influence the investor behavior is herd mentality, in which the investors follow the herd without taking into account the investor's underlying principles. So here the emotional and impulsive behavior is reflected. The investor behavior is also influenced by the market analysis and the investor dangers. Two well-liked tools for the market analysis, the technical and the fundamental analysis. The analysis and the fundamental analysis helps in selecting the investment based on the market patterns, stock values and the company fundamentals. The investment risk factors like systematic risk, unsystematic risk, liquidity risk, credit risk and the interest rate risks. They have an effect on investor behavior through impacting the investment choices, risk tolerance and overall portfolio management. So finally, it should be noted that the investor behavior is a very complicated phenomena that is influenced by a number of variables such as psychological biases, market trends, investment strategies, market analysis and investment risk. Now for investors, financial institutions and the regulators to make a wise investment choices support the market stability and it promotes the sustainable economic growth that must have a solid understanding of the investor behavior. Now the market behavior refers to the market participants, actions and decisions such as investors, traders, financial institutions and the policy makers. The market behavior has an impact on the overall direction of the market, the asset values and the market stability. Now understanding the market behavior is very crucial and critical for the market participants because it allows them to make the informed decisions and manage the risk and the forecast market movements. So the economic statistics, geopolitical events and the firm earning reports and the investor attitude all have an impact on the market behavior. Coming on to economic variables like GDP growth, inflation rates and unemployment rates influence the market behavior by influencing the investor confidence and the future market performance. The earning reports and other financial disclosures from the companies influence the market behavior by affecting the investor perceptions of the company's performance and, of course, for the future prospects. So, the positive earning reports can make the investor very confident and lead to a higher stock prices, while bad earning reports can lead to the lower stock prices. The warfare, the natural disasters, and the political turmoil all have an impact on the market behavior. So, these occurrences might cause uncertainty, insecurity, resulting in a greater market volatility. Finally, the market behavior is a complicated phenomena that is influenced by a variety of economic, geopolitical, and the psychological events. Understanding of the market behavior is very critical for making the investment decisions, the risk management, and also the forecasting the market moves. The market participants can detect the trends and opportunities, manage the risk, and promote the market stability by analyzing the market behavior. The market reaction to unexpected news or the events is one of the market behavior. Now, for example, if a firm produces higher than expected earnings, the stock prices may jump to reflect the good news. And when a company reveals the lower than expected results, the stock prices may decline to reflect the bad news. So, market behavior during a financial crisis or a recession is another example. Investor confidence may deteriorate during a financial crisis, resulting in a widespread panic selling and falling the asset values. And in contrast, during an expansionary phase when the market prices are rising, the investor confidence may rise, leading to increased risk taking and, of course, the higher asset values. Now, let us understand about the importance of understanding of the investor and the market behavior, which is a very pertinent part. Now, the first point is making the informed investment decisions. The investor can make the informed investment decisions by analyzing the investor and the market behavior, finding the trends and opportunities, and forecasting the market changes. Followed by the risk management requires an understanding of investor and the market behavior. The risk appetite, the tolerance levels can be identified by the investors, assisting them in risk management and also in their investment portfolios. The policy makers can use the insights into the investor and the market behavior to develop the effective policies that promote the market stability and the long-term economic growth. The regulators, for example, can employ the behavioral finance research to create the effective disclosures and invest protection policies. Next is your creating a useful financial goods. The financial institutions can leverage the insights into the investor and the market behavior to create the useful financial products that match the demands and the preferences of the investor. Now, coming on to the long-term wealth can be built by analyzing the investor and the behavior of the market, detecting the trends and opportunities, avoiding the frequent mistakes, and making the informed investment decisions. Now, understanding the investor and the market behavior can exactly assist the investors, yes, relating to managing their emotions, avoiding the illogical actions based on the fear or the greed. So, to summarize, understanding the investor and the market behavior is critical for making the educated investment decisions, successfully managing the risk, fostering the market stability, designing the effective financial products, and accumulating a long-term wealth and regulating the emotions. Now, investors and the financial institutions can detect the trends and the opportunities, manage the risk and promote the market stability by analyzing the investor and the market behavior, resulting in long-term economic growth and the financial success. Now, when we are talking about the market, let us now talk about the different types of investors, which is also a very important part of the stock market. Now, there are different categories of the investors, so let us unveil it one by one. So, the first is individual investors that invest their personal savings in stocks, bonds, mutual fund and other assets are referred to as retail investors, followed by institutional investors, which include the pension funds, endowment and hedge funds, which invest enormous sums of money on behalf of others. Next is your accredited investors. So they are high net worth people or the institutions who meet certain financial criteria and can invest in private placements and other alternative investments. Next is your angel investors. Angel investors are the individuals with a high net worth who invest their own money in the early stages startups in exchange for the stock ownership, followed by the venture capitalist. So there are firms or individuals who make the early stage investments in the company with a great growth potential in exchange for equity ownership and a stake in the company's management. Now, private equity investors are also there. They are the corporations or the individuals who invest in established businesses with the goal of improving their operations, increasing their value, and ultimately selling them for a profit. Then comes the sovereign wealth funds, are the government-owned investment funds that invest in a wide range of assets, including the equities, bonds, real estate, and commodities. Each investor has their own set of objectives, the risk tolerance, investing techniques, and the rules that govern their investment activity. Understanding the characteristics of each investor type can assist the individuals and the business in tailoring their investment offers to match the demands of their target investors. Now let us talk about the behavioral finance theory and how it is related to investor behavior. Now, it is very pertinent to talk about the different questions and have a debate and discussions and deliberations on the same. So, this knowledge of the behavioral finance theory and how it is investing the investor behavior is very important for all of us to understand and analyze the market. The behavioral finance is a branch of finance that blends, yes, the psychological and the financial principles to explain why people make irrational financial decisions. This is definitely a matter of concern. It tries to comprehend how the cognitive and the emotional biases influence the investor behavior as well as how these biases affect the financial markets. Now, according to behavioral finance theory, people frequently make irrational financial decisions as a result of cognitive biases, emotions and heuristics, which are the mental shortcuts that ease the decision making. And these biases and heuristics might include the investors to overreact to the market news, having on to failing assets and make crowdsourced decisions rather than independent ones. The availability of heuristics, for example, is a cognitive bias in which the people decisions based on the readily available information rather than all relevant information. So this might lead to investors focusing on the recent market patterns, dramatic articles and the news rather than having a long-term view of the market in finance. Another example is the sunk cost fallacy, which are the cognitive biases in which the people continue to invest in a long-lasting and the losing investment despite the fact they have already put a significant amount of money into it. So this bias may cause the investors to hang on to losing investments rather than cut their losses. So here are a few fundamental principles in the behavioral finance and how they relate to the investor behavior. The first is the loss aversion. The behavioral finance acknowledges that the people are more sensitive to the pain of losses than a pleasure of profits. So the loss aversion can cause the investors to take excessive risk in order to prevent the losses or to hold on to a lost investments in the hope of breaking even if this is not the mostly financially sound ones. The next is your prospect theory. The prospect theory contends that the people make decisions based on imagined rewards and the losses rather than the absolute outcomes. So this changes in the wealth compared to a reference point such as the purchase point or the previous high point are more sensitive to the investors. So this can result in a varying risk preference based on whether a scenario is perceived as a potential gain or a loss. The next is your individuals are influenced by the conduct of others and tend to imitate the behavior of the crowd. According to behavioral finance, the herding behavior can contribute to the market bubbles and subsequent crashes because the investor follows the trend without independently examining an investor's underlying principles. The next is your framing. The manner in which the information is presented can influence the decision-making. Individuals might react differently to the same information depending on how it is framed or presented. According to behavioral finance, even if they represent the same likelihood, presenting a possible investment with a 90% success rate is likely to be more inciting than providing it with 10% failure rates. Next is your mental accounting. The mental accounting is the tendency to divide the financial resources into different mental accounts, resulting in different decisions making for each account. Rather of considering their total portfolio, investors may treat particular investments or the funds independently. So this can lead to a poor decision making, such as selling a profitable investments to pay the losses elsewhere without considering the entire impact. So this is what is called as mental accounting. So when you have a deep understanding of the behavioral finance, this actually helps and explains why behavior of the investor is in a particular pattern, why the overall investors do not always act rationally and in their own best interest. Now, individuals can make a better financial decisions if they recognize the account for their behavioral biases. So it emphasizes that the significance of self-awareness, diversification, disciplined investment techniques, and seeking the expert guidance in order to reduce the impact of behavior biases and improve the long-term investment success. Now let us move on to another important aspect of the stock market and the market behavior. That is, what is the concept of market bubble, which is a buzzword and people are talking a lot about it, and how the market bubble and how they are created by the investor and the market behavior. Let us dive into this. A market bubble occurs when the values of the assets, such as the stock, real estate, or the commodities, increase to unsustainable levels that are considerably considerably above their intrinsic values. The market bubbles are caused by a mix of investor and the market behavior, which can result in a self-perpetuating cycle of buying and selling that raises the price above the inherent values. So the market bubble usually progresses through numerous stages: the expansion stage, the excessive growth stage, and the euphoria phase occurs when the investors become overly optimistic and assume the asset will continue to increase indefinitely. The prices may become disconnected from the asset's underlying worth at this point. So the market bubbles eventually collapse, frequently as a result of a negative occurrences or a shift in the investor opinions. So as the investors begin to sell, the prices can fall and resulting in a correction or a crash. Often we hear about market correction mechanisms. So this is all related to this kind of a bubble. So the investor behavior and the market dynamics both have a deep role to play in the formation of the market bubbles. Some of the most important causes of the market bubbles are the speculative behavior, the leverage and the cheap credits which are available, overly enthusiastic expectations, unrealistic expectations of the future growth and the earnings typically fuel the bubbles, and the investors may overlook or undervalue the asset's hazards and get excessively excited about its prospective rewards. So this unreasonable euphoria might result in inflated prices that are disconnected from the underlying fundamentals. The next is your traditional value methodologies, which may be overlooked or rejected under a bubble-like condition due to lack of basic investigation. So this might contribute to a misalignment between the asset prices and the intrinsic values. Then there is a positive reinforcement which may occur as the prices climb, strengthening the investor's conviction in the asset and the future potential. So this feedback loop causes a self-fulfilling propensity, driving up the prices and enticing more investors until the bubble burst. So it is vital to highlight the detecting market bubbles in a real time. It might be difficult. So even experienced investors and the financial professionals may find it very difficult to forecast when a bubble will begin and when will it burst. So there are some market cycles which also I want to talk in this particular lecture. The market cycles are periodic, the patterns of the market behavior that occurs over time, and a multitude of the factors they drive these cycles, including the investor sentiment, economic conditions, market fundamentals, and understanding the market cycles is very crucial, critical for the investors because it allows them to make a better judgment about when to buy and when to sell. So during this stage, the market is typically undervalued when the prices are going down and the investors begin to see the future growth potential. The talking we are talking about here is a bull market, a bear market, and the accumulation phase. So the market cycles, what we are talking about, they are divided in 4 stages. So the first stage we will be talking is on the accumulation phase. At the start of the market cycle, the investors who are very cautious during the preceding bear market begin to accumulate the equities at a cheaper prices. Now during this phase, the market is typically undervalued and the investors begin to see the future growth. Then is a bull market phase when the prices are moving up. The distribution phase. As the bull market phase proceeds, the investors start to sell their holdings to realize the profits and grow more cautious. So this cautious a phase of price increase that is slower than more consolidated phase. So the market prices declines during a bear market, and as the investors lose faith in the market, slowing the economic growth and unfair news may, have a pessimistic outlook. So basically, when you talk about the market cycle, it is very crucial to remember that market cycles can vary in the length, in the intensity, and they are not always predictable. While having a better grasp of the market cycles can aid the investors in making more educated choices. And it is crucial to always keep in mind that nobody can foresee how the market will behave in the future. So this was all about the market behavior. Thank you so much.